Good morning. In this presentation, I'll be giving an overview and a part financial performance of Ausnet Services Limited Australia. Please sit back and relax and let me take you through. I'm giving you a brief agenda as per what we would be speaking about throughout the entire presentation, starting with the overview, then coming to the highlights. I'll explain the income statement, then the financial position, later on coming to the cash flow statement and the annual reports, ending with the conclusion of what we have gone through the entire presentation. Starting with the overview, Ausnet Services is Victoria's largest diversified energy delivery service, providing electricity and gas services in and around Victoria. They operate over 11 billion distribution assets. The company is based in Melbourne and is planning to expand in the future at the same time. The energy power supplied by Ausnet Services is said to be at the cheapest price available. Ausnet Services is also listed on the Australian Stock Exchange and the Singapore Stock Exchange. Now looking at the highlights of the financial performance between the financial year 2016 and 2017. We can start by seeing that the revenues have had a decrease of 2% compared to 2016, being $1,919 million to $1,881. Though it may not be that much of a difference, they still try to make sure that the cash flows through their operations have been on a more positive variance as compared to the negative variance. The total dividend for the year was 9.8 cents, which would be 3.2 excluding the special dividend, 3.2% of the total shareholders of 12 months return as of the 31st of March 2017 compared to the previous year, which was 8%. The cash flow was 742 million Australian dollars as compared to the previous year, which was 710 million Australian dollars. Some of the non-recurring costs that occurred in 2017 due to the impact of severe storms in October 2016, along with the redundancy and reconstructuring costs associated with the business efficiency plans, which have had a basic impact on the company and the revenues of the company. In 2010, they had achieved 47 million in efficiency profit that has been focused on their ongoing efforts of cost management. They also believe that in the coming year, that is 2018, they would be trying to save up more because of the taxes, at the same time the depreciation, and try to impact all the VAT that would happen on a more lower rate. In this slide, we come to see the income statement of Ausnet Services Limited. It gives you an overview of all the revenue that's come in the business as well as the tax. Compared to the year 2016, the company has not made that much profit as per what it did the previous year this year, but it does not have that much of a variance of any of the other costs going on. We're now coming to the financial position of the company, majorly discussing the balance sheet that is here in front of you. As we can see, compared to 2016, the net worth of the total assets was more compared to the year 2017. With my assumption, I believe this could be that the company could be borrowed more funds in order to improve the financial performance, or at the same time with regards to the new focus strategy that they are trying to implement in the next 4 years. The money could be going into the new technologies and new assets that the company would be requiring. This in the next slide, which I will come to about the equity, which will help us understand more about how the company is trying to function because of the rise of the equity and so on. In this slide, it's the continuation of the balance sheet. We understand that there is a rise in the equity from the previous financial year. Also, the assets are more in 2016, as I mentioned earlier, than 2017 due to the borrowings. Hence, it can be seen in the liabilities section, where there is about a 600,000 difference between the previous and the current year. However, the retained profits did not make a lot of difference or impact the organization on a large scale. Retained profits is basically the profits that are absorbed by the company after paying off dividends, paying off dividends towards shareholders and stakeholders, all the expenses that have been borne for the functioning of that particular year. Now coming to the cash flow statement of Ausnet Services Limited. The cash flow statement of the company depicts the inflow and outflow of cash, that is, the money that comes in and out of the company. The cash flow statement is divided into 3 sections: the operating activity, the investing activity, and the financing activity. In the operating activities here, we can see that there's not much difference compared to the previous year and the current year. Also in the financing activities, there's not much difference, as we understand with the borrowings. They have used a more profound method of trying to manage the financial activities of the company. Also, in 2017, it's better, though not a large extent, but something was always better in the borrowings, and assets were consistent, thus returns are not heavily fluctuating towards the Now coming to the annual ratios of Ausnet services as of 31st March 2017. First, we can start with the net profit margin. The profit margin ratio is basically calculated by dividing the net income by sales. Net sales is calculating by subtracting any returns or refunds from gross sales. Net income equals to total revenues minus total expenses and is usually the last number reported on the income statement. Here the net profit margin of the company is 13.79%, which is not bad compared to the industry value. Normal ratios such as current ratio, quick ratio. Current ratio is the liquidity ratio that measures the company's ability to pay short-term and long-term obligations. To gauge this ability, the current ratio considers the current total assets of the company relative to the company's total liabilities. Here the current ratio is about 0.12% difference compared to industry value. That is the current ratio of Ausnet services is 0.83%. 0.83. Now coming to quick ratio, it is the measure of how well a company can meet its short-term financial liabilities. Here the company is more or less at the mark as it is just 0.02 difference. Also at the end we can see the debt equity ratio, which is the most important for a company. It is a debt ratio used to measure the company's financial leverage. This is done by calculating the company's total liabilities by its stockholders' equity. Here we can see that it is 1.8, which is relatively good for the company. At the same time on the side we can see the total sales over the years as well as the total assets. We can see from 2013 to 2017 there has been a decrease in the value of the assets. That is majorly due to the usage of all the assets, majorly land, machinery, factory, which does depreciate over time, so the value doesn't depreciate, but there's not much of a drastic change. Whereas the sale has been more constant over the years, they've made sure they have tried to keep up to the market standards. In this slide, we can see a more detailed explanation of the ratios of the company, majorly knowing the financial strength of the company ratios, the efficiencies, the profitability, and the management effectiveness. Finally, coming to the last slide, which is the conclusion. Here we understand throughout the entire presentation, I've made sure to explain the past 5 years financial position of the company, also the company has adopted a more efficient form of working. At the same time, they are consistent on trying to work towards the 5-year plan strategy for 2021, and their focus towards the strategy has made sure that they are well aware of their surroundings, the new technology, keeping up with the market, and reaching out to more and more customers as they can. Thank you for your time and patience, for hearing me out and letting me present the presentation to you. Thank you. Have a good day.